Hello, everybody, and welcome. We're getting started here on our event this afternoon, Accelerating the Green Transition Through Sustainable Supply Chains. It's great to have you here with us. I'm Diane Holdorf, World Business Council for Sustainable Development. I'll be moderating the session, but it's exciting to have a kickoff today with our opening comments from Francis Malige, who's Financial Institution Managing Director. Please, Francis, over to you.
Thank you, Diane, and welcome everyone. If anyone wants to come and have a front row seat, they are available, and I promise we will not get offended if you have to leave before the session is over. So please do come and join us at the front here. We'll feel less lonely. It's my great pleasure to be here with you. As Diane said, I'm the Managing Director for Financial Institutions at the European Bank for Reconstruction and Development. This is COP26. EBRD is about 31 years old, so we are not much older than the COP. And green is a big priority for us. So let me start here on this panel about supply chains and sustainability challenges with a few facts. First of all, when we look at net zero targets, we see that supply chains are a massive question. The emissions from supply chains often represent more than 2/3 of the global emissions, as opposed to the emissions from just the main corporate sponsor of that supply chain. In some cases, it's even 90% in the case of distribution. So for a corporate to be tackling their own emissions alone is not just good enough. And Citi just published actually the same analysis on stranded sovereigns. You know, it's the same argument. It's how do you measure the sort of scope 3 emissions of sovereigns. Now, of course, there's a lot of climate risks, there's a lot of climate measurements for global supply chains, but we don't seem to see much or enough action on the ground. Now, why? We have been financing green projects for a very long time. As I said, we work across markets, irrespective of the size, to promote best practices in climate change mitigation. We've delivered more than 5 billion of climate finance in partnership with more than 160 financial institutions across our 38 economies of operations. And this has delivered over 200,000 green projects since 2006. We have developed specific green value chain loan programs, such as, for example, in Morocco. We've developed tools, one of which is called the Green Technology Selector, which you can all download on your cell phones. And it helps you choose, if you're an SME, anything from new windows to industrial boilers to, you can have it in Arabic in Morocco, you can have it in Mongolian in Mongolia, you can always have it in English, of course. And you can pick windows, you can pick refrigerators, and you can pick industrial equipment as well there. But simply scaling up these sort of things will not be enough, and we need to use more tailor-made solutions to reach deeper into the supply chains. Why is that? Because to actually impact the entire supply chain, multiple stakeholders need to come together. Large corporates need to set out their company targets and ambition that sends a clear signal to their supply chains. SMEs, on the other hand, need to have the capacity to understand what the sustainability targets and climate risks mean for their operation and take action. Data is a huge challenge. To assess their carbon footprint is much greater than what they have today. And if each corporate has a separate set of requirements, it only multiplies the difficulty. And there I think banks have a big role to play, because banks also need to measure the carbon footprints of their clients increasingly, and they then can turn that into an asset, into a data supplier role to the entire supply chain. And I think the banks of tomorrow will be much more data-driven. I'm sure the risk colleagues will agree here in terms of helping manage this supply chain. I do believe this is actually a business opportunity for large banks like Citi. So we're therefore very, very pleased to work together with Citi to promote sustainability through supply chain financing models. This is relatively new to the EBRD region of Central Europe, Eastern Europe, Central Asia, and North Africa. These are relatively new technology. And I'm very happy that Citi and the EBRD are working together on bringing a one-stop shop solution to the markets. Now, the program that we are developing together leverages the traditional Citi supplier finance solution and brings this together with the additional credit capacity that can be provided by the EBRD, particularly in times like today of economic uncertainty. In addition, the EBRD can support the program with technical assistance to small and medium-sized enterprises, and that's currently operational in 30 of our 38 countries of operations. I'm sure the panelists will want to share more and have much more insights. Ladies and gentlemen, over the last year, the world has understandably been focused on dealing with the pandemic and its economic impact, but the pandemic has also revealed many of the challenges in our global supply chains. Our biggest challenge remains heading off the climate crisis that threatens us all unless we look for innovative solutions to the way we produce, supply, and finance products and services. And with this, words of wisdom, now let's get practical. I'm passing over to Diane Holdorf, who will moderate our panel. Thank you, Diane.
Francis, thank you so much. That was great. What a way to kick us off. And you really brought a clear focus in on the importance of having really solid data and really good tools to support value chains in this transition that we've got to urgently address. So thank you for those opening comments. I'm excited now to introduce our panel, and we'll go to discussions there. Sitting next to Francis, we have Lauren Hankinson, Senior Manager for Government Affairs at DS Smith. Welcome, Lauren. Next to Lauren, we've got David McNeil, Head of Climate Risk at Fitch Ratings. Great to have you. Then we've got Alzbeta Klein, Director General of the International Fertilizer Association, bringing the value chain really to life in your role here. Thank you. And then next to me here, Piyush Agrawal, Global Head of Climate Risk and Chief Risk Officer for Citibank. So great to have everybody here today. Looking forward to our discussion. And Lauren, I think I'm going to open with you first. So bringing in the perspective of DS Smith, big corporate global printing company, you know, we're seeing this increasing focus on E, S, and G. All three are much more highly on the rating surveys. COVID actually has helped to draw this out quite often. As this focus evolves, how are you finding it to align and adjust? And is it having an effect on both your goals and how you operationalize them?
Hi, thank you for your question. So I'm from DS Smith PLC. We're a FTSE 100 paper and perm packaging company. The background to the company is we are engineers, we're scientists, we're R&D specialists. So we are always looking for ways to design out waste, not just from an environmental perspective, but also because it's good for business as well. It's good for our customers, and we can pass along those savings to our customers. So we're very good at the E part of ESG, and we're very vocal about how good we are at the E. We're equally good at the S and the G, apart from we're not so good about talking about it. So with our Now and Next strategy, which is our sustainability strategy that we launched last year, we really focused on amplifying the work that we do around social and governance and ESG ratings. And for example, we're very good in health and safety, but we're just not very good about talking about our track record in health and safety. There are some areas that don't naturally fall within our remit, I suppose. Human rights would be one example. Our major markets, our three main markets are EU, the UK, and North America. So we don't operate in those areas where human rights are a particularly big contentious issue for us, we're already operating in heavily legislated arenas. So there's some areas that we excel at and we're very good about talking about, and then there are other areas which either they don't naturally fit with us or we are getting better at talking about them. Our Now Next strategy is one example of how we're going around readdressing that balance between the three component parts. I think you can see that as well. EcoVadis recently rated us as platinum, and I think that's part of it around our messaging and us amplifying those key messages.
That's great, thank you. It's important that you brought up this aspect of materiality, both in your own operations and what that value chain looks like. And I think that was great, thank you very much for that. David, let me turn to you next. So again, bringing in the ratings view from Fitch Ratings, we know that climate risk is a financial risk. Increasingly, that's been made very, very clear. How are you seeing these climate risks along supply chains being accounted for by rating agencies like yourselves? Are you seeing big shifts? Are you seeing new metrics? How is this evolving?
Yeah, so I think in general, to interest in how the ratings agencies are looking at these problems, how we're integrating it into our credit rating analysis. So in this context, for 3 years, we've actually been publishing our ESG relevance scores. So this is a systematic scoring framework demonstrating the impact of ESG factors on the ratings. So typically within that, we've seen much more financial materiality from the governance pillar. So aspects such as management strategy, financial transparency, etc. For corporates, we actually see only about 3% of elevated environmental scores. So it's perceived as an issue that's had historically less ratings impact, but we recognize that over the next 10 years, with tightening regulations, with more extreme weather and climatic conditions, that this is likely to change. And I think also in the context of the TCFD and some of the work that's been done there, there's a growing recognition that actually net zero strategies, low carbon transition, these are actually integral parts of management strategy. So we've seen this clearly throughout the pandemic with some of the supply chain fragilities that we've seen with some of the ongoing challenges in, for example, the semiconductor supply chain, where the suppliers that are adequately diversified, that have taken contingency plans for some of these risks, that have looked at, for example, in the context of Taiwan, the record drought there, which has compounded the supply chain issues. Those manufacturers that have planned ahead and have integrated, for example, their procurement, their product design, their manufacturing activities are the ones that are better prepared. So increasingly, I think we recognize that there will be a governance aspect of this, and that's something that's coming into focus. But there'll also be, I think, cross-cutting issues across sectors when we look at Scope 3 specifically. So thinking of one example, the car manufacturing sector, you see the likes of Mercedes-Benz implementing 2025 targets for full use of green steel. That then obviously leads to impacts on commodity processors, on steel producers, which then leads to impact on iron ore miners. So there's all these kind of ripple effects through the value chain that we are trying to account for in our ratings and we're looking at constantly.
And how are you seeing performance against those ratings? Just give me a quick reaction. Are you seeing fast shifts in the companies that you're putting those new metrics against?
I think it varies sector to sector. There's some sectors that have moved more quickly because there's clearer kind of regulatory drivers, utilities, autos are kind of clear examples. There's others such as manufacturing where the picture's a bit more complicated, where maybe emissions trading schemes aren't having a direct effect at present, but we can see some of the kind of changing kind of demand drivers, some of the kind of changing consumer behavior around net zero. So one of the things we've done is to partner with the EU and PRI and to integrate the inevitable policy response into what we call our climate vulnerability scores, where we're looking at 2025 out to 2050 and scoring corporates on their exposure, both to regulatory risk, but also some of these changing kind of macroeconomic dynamics, changing consumer behavior and value drivers. So that's kind of looking at the creditworthiness of those corporates just now and then looking at how those could be impacted in the future.
Oh, that's great. Thank you. Super helpful also to think about how quickly sectors are transforming. It creates a whole different view on investment portfolio management as well as risk management. That's great. Thank you so much, David. Piyush, let me come to you next. So, we've talked here about materiality, the use of data, the sectoral approach. You're coming into this from Citi with a big portfolio and a really big lens on what risk has to look like. What are some successful strategies that you're seeing and perhaps applying for decarbonizing and building resilience for supply chains based on climate risk?
Sure. Thanks, Diane. So let me just step back. And if you think about the supply chain, which is a predominantly part of the Scope 3, it's the area we don't talk about much because of the lack of information. But really, to make a dent in climate change or net zero, it's the area we need to focus on. So I'm really glad we are coming together to talk about this. Now, if I expand on the supply chain, the real composition of supply chain is the SME ecosystem, right? It's the small, medium enterprises. And to exacerbate that, it's probably in the emerging markets, where again, information becomes even more limited in terms of activity. So when you think of global capital isn't really going directly into that ecosystem directly without the help of our large clients, because global banks and asset managers tend to be in the global landscape. So the way I think about where we've got to make progress is really radical collaboration or partnership between banks, global banks, that are at the forefront of this action, along with our large clients who are all headed the way and moving beyond just scope 1, scope 2 to think about scope 3, right? So their supply chain. And Citi's partnership with EBRD is just a starting point. I think as you get more and more engaged on the supply chain, I think we're going to see significant progress. I think what David explained in terms of information and data and coming to us is going to be key in our success of how we think about what we do with that. But there is a significant amount of capital that needs to go in through both technical and financial help. And that's why we need, probably a lot more partnership with local regulatory and global regulatory agencies as we go in. I think to the point of resiliency, two things come to mind, I'd say. On behalf of our large clients, I would say you can't boil the ocean and change everything overnight. So you've got to do or learn to do a vulnerability assessment of what your supply chain is and who will be most affected. And again, it's a very infant area where people haven't spent time. I mean, I know we have a hard time sometimes doing the same climate assessment, not just transition, but even physical risk. So you think of a large semiconductor manufacturer, and if you're predominantly based on one supplier and the guy gets flooded for 3 months, that's a problem. So you've got to start getting into these vulnerability assessments and then start from the most to the light touch in terms of helping the resiliency of the supply chain. And you're seeing the impact today, even without direct climate, with COVID, of how strained supply chains have become. So it's going to change much more as we go forward. I think the second aspect I would touch on will probably be the availability of capital. So this is trillions of dollars that need to go in to make supply chains green. And you can't be dependent on local banks or even global banks. To make it scalable, you've got to bring in the capital markets. And so to bring resiliency in of the capital markets, one of the things which we've all been talking about is really data and information. And what you don't want is a few bad actors of greenwashing that then bring contagion into the market, because you really want this to be a sustainable capital market solution. So I'm looking forward to all of these changes, and I'm really glad. I mean, I know lots of our clients are actively talking to us about this. We've gone in with some structures already, but this is just the tip of the iceberg. So I'm pretty excited about, the supply chain change.
I think that's great, Piyush. You brought in so many key points there between the importance of deeply understanding a value chain, the importance of having data and information to assess the real risk and vulnerabilities, and success against resilience in those value chains, and then the data that it takes to make credible, consistent assessments of that performance. And these are some of the really big key solutions that we need to be able to accelerate this work and put all that money that's actually sitting there into action for better outcomes. So thank you, that was really helpful. What strikes me is that a lot of the conversations so far, of course, Lauren, you brought in paper and packaging. David, you and Piyush have talked more about the tech sectors, auto sectors. We haven't often spoken enough at these climate COPs about the role of agricultural systems. We're starting to get a lot more pickup this year with the whole focus on land use change and deforestation, but the whole space of agriculture for food and textiles is key. So with that, I want to turn to you, Alzbeta, and invite you in, because reducing agriculture's carbon foot while still ensuring global food security, health, and equitable outcomes is a really critical challenge. So talk to us about how the fertilizer industry is managing this climate transition risk. They're very much at the heart of a lot of these changes, and also at the heart of some of the risks associated with carbon footprints. And that's a tough balance to strike. So give us a bit of information around how we're going to maintain food production and yet decrease the footprint of ag.
Thank you, Diane. And it is actually a critical question, but let me go back to the initial topic of this conversation, supply chains. Where we are today is at the greatest traffic jam of the century. That's what our supply chains look like today. And because we're in a greatest traffic jam of a century, we are realizing that those intermediate industries that feed us all, that make sure that we can sit here with the lights on, are getting a lot of attention. So there is a little bit of silver lining for all of us to realize that we have to pay attention to everything else other than just the end of the value chains. So agribusiness, agriculture value chains, quite complex, quite strained after COVID, are culprits of a lot of climate change and yet also victims of the climate change. So how do we think about it conceptually? I think there is a few things that we need to think about. First of all, we have production of inputs that go into agriculture, and technology is there to do quite a lot of work. I don't believe we have technologies today to get us to net zero, but we have technologies to get us quite a long way from there. And here I'd like to highlight the work that we have done with EBRD and the IEA on decarbonization of the ammonia value chain. And that shows the roadmap to producers how to get there. So that's just one bucket of issues. The second bucket of issues is the actual agriculture on the farm, point of use, scope 3. What do we need to do about scope 3? There is a whole lot of education, there is a whole lot of agtech startups that need to come in, and there is a whole lot of innovation that needs to come in. But we're also seeing societal trends, changes of diets, changes of how we do things that we haven't done in the past. And I think the balance that we need to strike is solving two equations. One, we are feeding about 7 billion people today, and about half of the people on this planet are fed because we have managed to do agriculture a bit more intensively than we have done 300 years ago. Yet, we have limited planetary resources and we need to feed 10 billion people 20, 30 years from now. So how do we make sure that we do not deforest whatever is left there? How do we make sure that we have forests in many places around the world intact? And therefore, how do we create more out of less? How do we actually get the value on the land that we already converted, that we can create crops to feed the 10 billion people? It's not an easy equation, Diane. We need to think about it very, very hard because we have very clear constraints. But I do believe that science and innovation is going to get us there over time.
Absolutely, Alzbeta. I think you raised the complexity challenge in agriculture and the razor's edge that we've got to ride to make sure that we maintain food security and increase production without expanding the footprint of agriculture, which means addressing degraded lands and addressing practices at the farm level. Talk about distributed scope 3 practice shifts. So, you know, there's a lot there, but there's some really good progress underway, and it does bring us back to technology solutions and introduces the role that key practices play as well. So thank you. So Frances, let me come back to you then, because we've had some really great inputs into all of this already. Coming back on the role of the finance sector then, talk to us about what it means to increase sustainability along these extended value chains. How do we get there, particularly when we think about the middle income and developing countries where, as Piyush was saying, we can't necessarily depend on the local governments or the local banks? How do we actually move some of this finance and change in behavior through?
Well, clearly more money is needed, as you said. But let me make a couple of points to this question, because I think a lot of it is in the regulation. As one anecdote, a few years ago I was sitting down for a coffee with the central bank governor and talking about, you know, green and sustainable finance, and he wasn't very comfortable with supporting it because he said it's a social decision. It's not my job as a central banker to be setting social priorities. It should be fiscal policy, it should be, because the moment I give special treatment to green assets, next day they're going to ask me for special treatment for SMEs or for other things, and there's no way that green assets are inherently less risky than normal ones. The same one, I've seen the sea change, and that's actually making me optimistic. Now that we look at climate risk as a risk, then you say, oh, okay, so if you don't include climate risk into your stress testing for your banks, you're going to have a problem at some point. Some of your banks are going to go under because they have undermanaged their climate risk. Then he's on board. And now the same is saying, okay, help me because I want to do it, but I don't know how to do it. And that to me is a great point to be, because when someone doesn't know how to do it, there is someone else out there that does, and that someone tends to be the World Bank, the IFC, the EBRD, global banks like Citi and so on, that can provide the technical assistance. So that to me is a big sea change, and the way in which the financial sector can support the sustainable supply chains is by actually insisting that the people that they lend to measure their climate risk and their climate impact. And that is coming. And the second part, I think, just a few weeks ago, actually, last week, I was sitting down with a very exciting fintech company that is actually helping manage the risk of supply chains by solving an issue which I think is a great issue. I'm sure the colleagues in Citi would agree, making a link between the accounting systems of the SMEs along the chain directly into the risk management tools of the banks. And that is a big problem. When I ask banks, why don't you lend more to SMEs? It's because they fly blind, essentially. You lend to an SME, especially in an emerging market, what you'll get, if you're lucky, is a proper set of accounts every 6 months with a 3-month delay. That's if you're lucky. Like if you're not lucky, it's not a proper set of accounts and you receive it later. And so that means that you can't actually see when the company is going off the road. You will see it when it goes bust, but you might not see it before that. If you have this sort of real-time data link, then your appetite for risk is bigger. And how much more difficult can it be if you resolve that problem for accounting data to resolve that problem for climate data as well? And so to the extent that then, as a bank, you measure with standards that are actually the same across the banking sector in the country, the climate risk of your SME clients, you are going to make progress. And the last thing I'd like to say to that is, these days when I ask a global bank, and unfortunately so far, I'm not sure that Citi is an exception, they say, okay, cement, we know cement. We measure cement emissions. Steel, we know steel, we measure. SMEs, not sure, it's too small to matter. But what this supply chain exercise tells us is that when you have one global corporate that has 3,000 SMEs as suppliers, then the 3,000 small SMEs taken together start to matter a lot more. And so having the technology to go and measure that and to take a holistic view on supply chains is going to be super important. Now, that's why I think the banks matter most, because if you take an analogy of the economy as the human body, I'd say the companies are the muscles and the banks are the blood circulation system. So if you can put in your blood cells, if you can put the climate DNA, you're going to reach every single piece of the body very, very quickly. And that's what I hope the banks can deliver.
I think that's great. And it's a lovely way to frame the visual of how to flow money through the system in a way that's important. You know, it's interesting just to reflect on what you were sharing in some of the comments here at WBCSD. We've had a lot of banking member companies come to us to say, I think you, Piyush, said we need radical collaboration. And they're coming to us and saying, okay, now is the time. We have to come together and create consistency in the metrics that we will be using and the data that we will accept to have credible investments into these global value chains. Help us create the platform in which we can do that so that we can go faster, because that's how we have to make this shift. And I love how you demonstrated that as well through your visuals of getting the blood pumping through the system. That was so great. Thank you. So Lauren, I want to build further on what Francis was just saying about what it takes to really dive into where often the Scope 3 companies in your value chain are operating, right? These are in markets, like Francis was just referring to, that don't have the resiliency, the data, the consistency of performance perhaps. How do you manage that through your supply chains? How do you reach out and engage for Scope 3 purposes?
Well, for example, DS Smith Paper and Packaging Company, we actually buy a lot of paper and inks. Those are two major products that we need to buy in. And we base our Scope 3 emissions calculations on a lot of assumptions. So we know how much it's costing us, what the tonnage is, and how far the end product has traveled to get to us. What we need to do, though, is break down what's in that end product. What are the component parts? So what are the chemicals? Where do those chemicals come from? How much do those chemicals cost? What emissions can be directly tied to those component parts of the end product that we then buy. So it's a massive project. It's a huge amount of engagement. It's very intense between our procurement specialists and our suppliers. And the more data that we can get, the more our calculations are realistic and they're accurate. So, for example, we use and we have used in the past the DEFRA databases around tonnage of paper, tonnage of ink. But that's an assumption that's based across the whole industry. It's not specific to us and it's not specific to our suppliers. So by having these conversations and constantly drilling down to the detail of their supply chains, it allows us to report much more accurately. I guess you could compare it to, how long does it take to drive between London and Glasgow? About 8 hours. But what if you're driving a diesel car? What if you're driving a Porsche? What if you're driving a Golf? What if you've got children in the back that need to have toilet stops all the time? All of these things affect the end set of data, which is how long will it take you to get from London to Glasgow. So we're at the very beginning of this process of collecting all the data and having these conversations. It's as I say, it's a huge undertaking, but we're committed to doing it. We reported in our sustainability report this year on our Scope 3 emissions, and we've committed as well publicly to net zero, and this is the direction of travel. So we're leading it from the front. Our goal is to be the most sustainable brand in our industry, and this is the beginning of that journey in some ways.
Yeah, that's great. Thank you for talking about, very truthfully, it's a big lift, and it requires a huge level of engagement to get all the way back to source and to engage suppliers in a conversation that they've perhaps never been asked to take part in, to get to data that they've perhaps never even thought that they should be able to track. And if there's one word here that every single one of our panelists has actually raised, is this data challenge. So, David, let me invite you back in. Data is obviously key to getting after this, but what have you learned through the work that you've been doing about what data in this space is actually decision relevant? How do you start to use that to help understand access to capital?
Yeah, so I was thinking back to my previous role as an ESG analyst and actually kind of working on Scope 3 footprints for corporate clients, whether it's pharma, whether it's car manufacturing, agri, etc. And typically the pattern that we saw was that a lot of the environmental risks were actually quite far down the supply chain. So thinking of an apparel company, raw material sourcing of cotton, that was very water intensive, so there was heightened risk of droughts in some supplier areas, and that was not just direct suppliers, but it was suppliers, so maybe 3 or 4 tiers down the supply chain. And I think it's really interesting in the context of the updates to the TCFD recommendations that just recently come out. That's going to move beyond kind of recommending Scope 3 where material or where relevant to recommending full disclosure of all Scope 3 categories. It's also recommending much more of a detailed focus on physical climate risks. So I think, again, that's quite a major shift in terms of disclosure recommendations. And I think, in the context of a ratings agency, some of the kind of aspects that we'd be looking at would be potential risk for refinancing, potential risk to profitability. So these could occur both within the operations, but they could also occur within the supply chain, kind of going to some of the points I raised about governance of climate issues internally and how you prepare your organization for these events. And then I think to the point around access to capital, typically I think investors increasingly are kind of looking to move beyond historical footprints. So climate data that might be 18 months to 2 years old by the time it's published and gives you an indication of how a company was doing historically. Increasingly, they want detail on forward-looking targets, both kind of short-term, medium-term, long-term. They want detail, again, in line with the TCFD, on CapEx and OpEx plans, management ownership of these issues. So really kind of going to the governance angle. And I think the interesting point around access to capital there is the explosive growth that we've seen in sustainability-linked bonds and loans in the past year, which again are kind of moving beyond the green bond kind of universe where it's limited to use of proceeds on a handful of green projects, whereas sustainability-linked bonds are actually linking this back to management strategy. They're encouraging companies to set goals that are kind of aligned with net zero strategies. And we actually see quite a lot of major fixed income investors approaching corporates and actively encouraging them to issue sustainability-linked bonds or transition bonds that have a specific focus on Scope 3. So I think it's an area that, with $1 trillion of issuance this year, we're going to see more and more momentum building behind.
Yeah, I'm glad you brought up this huge momentum behind the expansion from green bonds into ESG bonds and how that starts to make accountability flow into access to capital in a way that we haven't seen before. And it struck me that, as a ratings company, you're obviously rating companies who've got access to these. Francis, the companies you were referencing are folks that would never even come up onto a ratings screen. And so bridging these gaps are something that we also need to be able to do. So thanks. I think that's really key to, as you think through data that's needed in different parts of the value chain as well. And this kind of brings us back to information and what information is needed to make good decisions. And with that, I want to come back to you, Piyush, because as a financial institution, you've got very specific requirements and expectations on what your clients need to provide you to manage that risk and look at your overall capital allocation. We've heard some really good examples of what that can look like, but what does that look like across a Citi portfolio? How are you handling that?
Thanks. So if I can shamelessly steal from Francis the analogy, I think if finance is the body, I think data is the blood flow inside, right? So we need help there. Now, just on data, because we've talked about this so much, there's a few things that come up. Availability of data, then the quality of data, and then the timeliness of data, right? All three. I'll focus on the first two itself. Has been one of the hardest parts of really making risk assessments around this area. So when you think of the 4 or the 5 C's of credit, we can add climate risk, but what about climate risk do you analyze? Especially when even a lot of the data coming out today is divergent between different vendors. And more importantly, and this is a very nuanced point, we see ESG scores. To the extent we can get standardization, then you can compare, you can see progress, you can monitor trends. So we are hoping over time there is a little bit more regulatory engagement in helping. And I know several bodies are working on this, so it's just a matter of time to get that. But you'll see that as a big I think, tipping point of when standardized data by our large clients' disclosures is easier to process. And if there are gaps, I think our clients who have called partners are the ones who will help us, really figure that out. And then I think we solve that problem to a large extent. I think the second one probably is equally important, which is as we are greening the supply chain system, we are changing the risk profile of the supply chain. And so lending is the biggest risk-based assessment you do. And over the next few years, you're going to see an absolutely new creed of suppliers come into the system with their green technologies, right? And you're going to see the fallout or the extinction of several very strong suppliers who won't keep up with the time. So the entire dynamics of a supply chain is going to shift from what we are used to seeing to what we will see. This new risk profile needs a little bit more of what I call regulatory support or regulatory modification, because banks are not used to lending to new technologies immediately, which are not proven to be sustainable or proven to have cash flows immediately. I mean, you look at the big tech companies. In the early days of tech, banks weren't the biggest sources of capital providers, right? It came from venture cap, it came from equity, it came from everything else. But the speed of change that's happening in green, we can't wait for just venture cap or equity to fill that. You need banks. But to get banks to do a risk assessment in these new areas needs a little bit more of that regulatory intervention or regulatory modification, just so we can be equally big providers of capital. And then, of course, the capital markets will come in. So there's a host of things that are needed. But I think I'm going back to really data as the lifeblood of what we need to do for risk assessment.
Let me just jump in with one build on that, because you've spoken here a lot about the data, the information, teasing it apart to get at what you actually need, the regulatory environment that will enable that. But what about governance? Can you talk just a little bit about the role governance plays in that new risk assessment world, especially when looking at these new, greener opportunities?
No, absolutely. Thank you. So, governance you can look through many ways. So when I talk about the 4 or 5 C's, one of them you see is character, right? Of how you judge management, and therefore, as part of that is what is the governance from a client aspect of what they do, what their auditors do, and then also what we do internally. So it is an important part. That's the broader ESG. But if you can trust data, then automatically the governance angle will sort of get married into it and move forward. But I think the governance piece probably is easier to tackle than the climate data piece, just given the diversity. I'll give you another example on where I go with this. When you think of sovereign credit, and we think about the Western world and how their emissions have come down, that's great in a scope 1, scope 2. But if the Western world has moved manufacturing to the emerging markets and you move to a consumption-based model, all of a sudden your views change even on that. So I'm going back to how you tackle the data and where you put scope 3 and everything else, almost at a higher platform than the governance piece that I think is solvable.
No, I think that's great. And I'm glad you highlighted the point around the footprint of the value chain can shift the perception of governance very quickly. And I think that's an important aspect for us to think about, particularly as we look to these agile and rapidly greening transitions across value chains. So thanks for leaning into that just a bit. And Alzbeta, as we think about what it means to green value chains and decarbonize value chains, I mean, you're sitting at the heart of one that is on a pathway, it's in its journey, but there's obviously a lot of challenges to work through on that. So talk us a little bit about what does it mean to translate that into how you're monitoring sector performance and putting roadmaps in place. What's that like?
Thank you, Dan. I would like to actually go with Francis and Piyush together, because I do believe that it's data and it's finance that is going to transition the sector. First and foremost, the data. The industry has mapped out scope 1 and scope 2 by and large. Scope 3 is difficult. It is very difficult because it goes both ways, as we discussed, intensification versus extensification of agriculture, which you need to take into account. If you look at the agribusiness value chain, it needs a lot of funding. And it needs a lot of funding not only for things that are already green, but for things that are in transition. The sector is not perfect. The sector is one of the transition sectors. And I think it's really critical that we heard pledges today about financial institutions going to finance transition. Because if financial institutions are going to stick to what is already green, you won't be too busy. There is a lot of funding that needs to go to get us from where we are today to where we need to be in a very, very short time. When it comes to agribusiness value chains, it is not only plant inputs, fertilizers, and others that need financing. We need to find models and ways to finance the farmer. And I know that risk models for many banks are not allowing for efficient financing of agriculture in many markets. But this is where the value chains, as Piyush was talking about, move to emerging markets. And we need to find a way to do it in emerging markets as well as in the developed markets. So flow of funding is absolutely critical, and flow of transition finance is going to be there as a key factor. Data is very important, especially when it comes to scope 3, but also all the other data that companies need to make good decisions. And if I were to make a call, let us all work on pricing carbon. Let us all work on pricing externalities, because companies are looking at that and that they'll make better decisions if we are to do that. And let us also have carbon markets so that when somebody is doing a right thing on the farm, in the forest, they get value for it. And then we have bankers here in the audience who can actually monetize it, create assets out of it, and create value proposition so that that transition is not about a cost, but it's about an opportunity.
Yeah, and as we think about action, you've got some examples already that you can pull out. Are there any in particular that you'd like to share?
Happy to do so. Again, work in progress, very much a work in progress. But when you look at where the biggest challenges are in the ag value chain, it is obviously on the farm, and that is on the second one is in the nitrogen value chain. Nitrogen is all around us, but it's also not a nice thing to have in many cases because it can pollute. So finding a right balance, finding a right way to deal with nitrogen value chain is essential. And so, as I mentioned earlier, our ammonia decarbonization roadmap really provides a vehicle for companies that are serious about transformation to do that. But we have a new technology coming through as well, and that is green ammonia, green hydrogen. And we potentially could see a future where fertilizer industry will be basically a filling station for the maritime industry, where that nitrogen value chain will be about green ammonia, green hydrogen, and help decarbonize the shipping. So one message, Dan, that I'd like to leave here is that we have to stop looking at industries as separate buckets, and we have to start thinking how energy and food play together and how finance needs to influence all of those.
I am so happy you brought that example up because this is where it starts to get super exciting. You were jumping in. Go ahead.
No, I mean, I couldn't agree more because I think we've got to take our biases of industry cuts away as we're thinking about the future and look at the commonality in some of these. So I was smiling at the thought.
Yeah, no, absolutely. And these, when you think about agility, speed, innovation, transformation, and total blowing business models completely out of the water and reassessing performance, it's the great way that we've got to look at what the future can bring. So I'm gonna come back to you, Francis, in just a moment for some closing reflections, and then we're gonna open it up to the audience for Q&A, and this is when it starts to get really interesting because we get to answer your questions. We're gonna take questions from here in the room, but we're also gonna take them from all of our participants online. So if you're participating with us here online, please use the Slido tool. Get your questions in there, and they'll be fed into us, and we'll pose them to the panel as well. If you're in the room, you're going to need a microphone to ask your questions. We'll get some out there roving so that everybody online with us can hear what you're asking and how we're responding. But with that, Francis, let me come back to you and invite you to close in a similar way to how you brought us such an invigorating opening. You know, EBRD is working as a huge partner to financial institutions on these big shifts. You're working to further develop climate risk assessments and corporate governance. Where are you seeing the trends really taking us, and where can we all lean in to go faster?
Well, let me start by maybe offering a little bit of praise to Citi. I'm really happy to be sitting on this panel with someone who is both the climate risk and the chief risk officer, because that's the way to go. The bad news is, though, we did a survey of our partner banks earlier this year to see where they are to take stock. And I must say, you know, only 3% are there, where the chief risk officer is actually a decision maker in the climate risk. The other 97% are split essentially into three categories. Those that say, climate risk is not really important to us. Those are really the ultimate laggards, and it's still 20% of our financial institutions. Those that say, yeah, it's kind of important, we deal with it through specialized products, like the ones we do via IFIs, these green lines, energy efficiency loans, and so on and so forth. And another category, about 40%, that say, we handle this and through exclusions. So that's what you, Alzbeta, was saying around, if financial institutions exclude everything that's not green, we're going to be twiddling our thumbs a lot. And that's obviously not the way to go. So how do we work with them, having taken that temperature? We work on disclosure. We work on governance, and on disclosure, we are, it's actually relatively new for us. We've been doing green financing for 15 years. But so far, we were actually pushing these products individually, and we realize now that we need to shift up and we need to move to disclosure, and a standard like TCFD is helping us a lot because it's emerging as a global standard. There's 2,000 financial institutions that have signed on to it in 90 countries. So it's easy for us to point out to TCFD as being the thing that our partner financial institutions need to do. And we're of course ready to supply them with technical assistance when need be, when needed. for them to adapt to it. Another key development over the past few years, which has also helped us a lot, is the Network for Greening the Financial Sector, the NGFS, which now covers, that's a club of regulators, okay, central banks and regulators, now covers a bit more than half of the countries of operations of EBRD. And these days, when I travel and I meet a central bank governor, the first question I ask is, are you a member of the NGFS? And if they say no, or if they say, what is NGFS? I say, well, what are you thinking? This is coming your way. And by the way, also, we do provide technical assistance to central banks and to regulators on doing this. And of course, the EU has taken a big lead because the standard, the NGFS and so on, originated in the EU. But it's not just the EU. For example, the Moroccan Central Bank, working in partnership with us, has actually issued guidelines and started stress testing the balance sheets of the Moroccan banks this year. So that's a very welcome trend that I see. I'm just checking that I haven't forgotten anything. But these are the ways in which we work with our partner banks. And then finally, we've also decided that our funding needs to be Paris aligned. And that's not in 30 years' time. That's starting 1st of January 2023. So it means that from then on, you will not see an investment by EBRD in the equity of a bank anywhere in the world when that bank has not decided to go all the way, and when that bank does not have a commitment to develop a plan and become Paris aligned. You will not see a loan of EBRD to a partner financial institution that does not go to uses of proceeds that are compatible with the Paris Agreement. And that is also a sea change, a way in which we exercise that influence to the best we can on our partner financial institutions in our 38 economies of operations. So it's really important not just to talk the talk, but to walk the walk. And that's exactly what we're going to do.
I think that's great. And it's so important to have somebody like you out there advocating for building the awareness where it still doesn't exist as well, because they're not going to know how fast they're going to need to catch up. So super important. Well, this has been a great discussion, but now we get to make it even more interesting. I'd like to turn it over to our audience and welcome questions either for specific panelists or to the panel as a whole that we can then field. Any questions out in the audience here? Yes, can we get, there we go. Good, thank you, please.
Hello, good afternoon.
And please introduce yourselves as well.
I'm Giampiero Nacci from the EBRD. I have a question for the panel, but particularly, I guess, for Alzbeta and Lauren. Because Alzbeta rightly talked about carbon pricing as a market signal, really, to stimulate investment and create incentives along the value chains. In absence of carbon pricing, we know how complex it is. Just wonder whether you can share your view on other market mechanisms, or let's say to what extent the markets, the buyers are ready to recognize a premium to green products. Thank you.
I can start and then I'll pass it on to you. You're probably seeing it closer on the ground. At the moment, there is not a lot of recognition on a part of the customer, and neither is the ability to pay for the distinguished green products. Having said that, what I'm observing in the industry is the propensity to invest because they see new investment opportunity coming their way. So it's not necessarily that we have carbon pricing in all the jurisdictions, but the expectation that regulation will come and carbon pricing probably will happen in key jurisdictions leads the companies to innovate. And we are seeing it especially in the green ammonia space, green hydrogen space. Nobody's forcing anyone to invest, and yet we are seeing just about an announcement every month in that space, and that is companies are taking an initiative to actually do that. I would love to see the world where the supply chains recognize the product. We have seen it in selected commodities about a decade ago, and it's been evolving, and you've seen pricing that is differentiated, especially in food commodities over the years, but we have a long way to go in the intermediate value chains to recognize the green premium. On the way.
This isn't really an area of expertise for me, but I think that answer is pretty full and really helpful as well, actually, so I wouldn't add anything to that.
Great. Thank you, Alzbeta, for taking the lead on that response. That was good to dig in a little bit further. Any other questions here in the room? One more, and then I know we have some online that we'll turn to as well.
Yeah. Hello, dear panelists. Thank you. My name is Dmitry. I'm from Citi, Sustainability Measurement and Investment Platform. And my question would be to Piyush. So during your presentation, you mentioned the need of quality and timely data for climate risks. So could you maybe elaborate on that? So what is the type of data that is required? Is it like a physical climate risk data, satellites, sensors? What exactly? Thank you.
Sure. I mean, there's about, I would say, 300 or 400 data points that we get today. So I can't, rather than go into everything, what you're really looking at is probably consistency of data, right? So if I look at emissions or emissions intensity, it shouldn't be left to the vendor or the user to calculate what exactly that is. So whatever you are disclosing, whether it's scope 1, scope 2, or scope 3, we need a little bit of standardized taxonomy on what that means, and this is just going through what you have today. The second piece is going to be your futuristic performance. So as you're going through net zero and net zero target setting, the part we're seeing is the headline of what your net zero target might be. What we don't have is that different companies are taking a scope 1 approach or a scope 1 and 2 approach, or not, or sometimes a scope 3 for different setups. So again, consistency of data around what really is a net zero commitment. Is a net zero commitment truly company-wide, extensively all 3 scopes, or should we all just ignore scope 3 and keep it outside of net zero and look at scope 1 and 2 when we do the analytics? I can go on and talk about your capital commitments. So as you're doing your capital commitments and you're talking around governance of those capital commitments, how much of that is your BAU, but how much of that truly is going into green, right? That justifies what that support looks like. On the physical side, again, we don't have information on our clients' assets around the world. So as you're doing a physical assessment in what I call vulnerable markets, and as we do our own scenario designing and stress testing, the geolocation of these assets. But really for us, rather than for us to calculate, if you yourself are declaring those data points, I think it helps us really understand what's going on. So I'm happy to connect offline, give you a slew of these metrics, but it's really around the accuracy and the standardization. And I think several companies do a great job, but I'm really ending up comparing apples and oranges and trying to make an assessment. And I don't think we will do justice as banks to client data until we see some of that standardization.
Yeah, and getting to that scope 3, fast, consistently, incredibly, is the only way we're actually going to create the shift that we need. So great points.
I mean, just to add the point I made earlier, if a company says we're going net zero and look at how far we've come, but all of a sudden all you've done is sold your assets to somebody else, I'm not quite sure that that's the great way to achieve net zero, right? I mean, if you're really serious about climate change, or you've sold the asset, leased it back, and it's somebody else's scope 1, which is now your scope 3, it's that kind of quality of disclosure that probably helps us make a better assessment.
Good additional drive down, actually, because those are key differentiators. Thank you. Great. Why don't we move to one of the questions online? I'm going to turn the mic over to our appointed online question asker.
Thanks so much, Diane, and thank you as well to the panel. A great discussion. So the first question from our online audience is both to Piyush as well as Francis around reputational risk. So reputational risk and greenwashing is a major concern in sustainable finance solutions. How are banks mitigating this risk?
I'm happy to go first. So, I mean, reputational risk is obviously not new to us. It comes in all directions. And it's a complex rubric around how you design what is reputational risk and what might hit you. So there's always the unknown unknowns, and we react to that. But I think there's a pretty good understanding through our banking system with our bankers, with our transactors, of what needs to get escalated to special committees for reputational risk. And we do that on a regular basis. We've been doing that for years. So we've got a very active, environmental, social risk management policy. It lays out a few trajectories. And if you fall outside that boundary, it always comes up to a reputational risk committee of very senior members, risk managers, management team members that go through it. And of course, at the end, there's always a footnote, which is even outside of these metrics, use your judgment. So we do actively do that, and it's not really around just environmental issues. When our clients are busy building capex in areas of social change, or there are governance issues, all of these have been brought up. And I think over the years, I would say we've got or developed a pretty good muscle around thinking about franchise risk or reputational risk in these areas. But it's a very hard one because the gray areas are getting bigger, especially here. And I'll give you a quick example just to say this. We've got clients in, let's use the energy sector for years, 50, 100 years. We've been banking them around the world. Tomorrow, if a large transaction comes up and we're doing another new 5-year financing to a large energy major, is that reputational risk or not? And so how you create the boundaries of what we want to continue doing, it's very hard for a transactor. So there is significant judgment involved, but as we come here today through COP26, there are significant commitments we are making to where our direction of travel will be. And I think these things will lead to more reputational risk discussions. But overall, I feel very comfortable about the history of Citi and how we've managed through some of these reputational risks.
And we'll turn it over to you in just a second. I just want to highlight one key point that you raised, is that the issue of social justice is becoming inherently a climate risk. And we haven't quite spoken enough about how we're incorporating that, but you did just flag that within the reputational risk review. So just wanted to highlight that key point. Thanks for bringing that up. Francis, please.
Well, actually, I was going to go on that very point as well. I think the short answer is due diligence and judgment. You need to do your due diligence properly. You need to know exactly what you're lending the money for. And then there's some judgment element involved. And just to give you one such example, recently at our board of directors, we approved a credit line to a Polish financial institution for energy efficiency investment by Polish households. Now, that counts as green, even though we're actually allowing Polish households to finance gas boilers on the condition that they replace coal-fired boilers. Right? Now, I would prefer if every Polish household that we finance indirectly through that partner financial institution could afford a heat pump. But the truth is, heat pumps, just like Teslas, are probably out of reach of most customers in the world. And we've also heard, I think, not just today, but in the past few months, how important it is to reduce emissions now. Meaning it's a bit like a discounted factor, right? The discounted cash flows. A kilogram of CO2 avoided today is worth much more than a kilogram of CO2 avoided in 2070. Okay? So the pace at which we manage to reduce emissions is super important. So by helping a Polish household buy a polluting equipment, which is a gas boiler, but replacing the coal boiler, we're actually doing good for the planet, even though there's going to be emissions there. So whether there is greenwashing there, I'm sure there's some people in this very room or in this broader room that are going to say, no, this is not good for the planet. Some other people will actually ask the question, aren't you, by allowing people to use gas, encouraging them to stick to gas in 15 years' time when the time comes to replace the boiler? And I'm like, well, if they pay for the connection today, that's not going to be a big factor in the decision in 15 years' time to replace the technology. The policies of the Polish government are going to count for more, the price of energy is going to count for more, and the price of the technology is going to count for much more. So in that case, we made a judgment. We said we stick to our principle. We are going to help Polish households buy gas boilers because we think, again, a kilo CO2 saved today is worth much more than if we wait 10 or 15 years for the heat pump technology to be available. So there's judgment involved, and there's knowing exactly what, and it helps us to be a project bank, because we have rarely lend for general corporate purposes. to anyone. We lend for a project, we lend for a specific capex, we lend for SME loans from a bank and so on, and that makes it easier for us to actually have a much better handle on where our money goes.
Francis, thank you. That was great. And you brought in another awesome analogy that I just want to pull back up into our lexicon here, and that is applying the concept of discounted cash flow to investment in reductions through new technology now, and how you actually use that to accelerate. So great. Thank you for that. I think, do we have any other questions in the room? I know we have more questions online, so I think we'll move to another question from our online participants.
Thanks, Diane. This one is for Lauren, a little bit about the strategy. So the question is, how does your sustainability strategy tie in with your corporate and shareholder goals? So herding cats.
So our sustainability strategy was launched last year. It's now and next. It's what we're doing now and what we're going to be doing next in order to reach a very specific set of 25 goals. Our corporate goals, corporate strategy is redefining packaging for a changing world. So we're looking at designing out plastics, for example, because if you look around you, what does that changing world look like? Well, it's climate crises, it's environmental crises, it's plastic pollution. We're a strategic partner of the Ellen MacArthur Foundation, and that really drives our work in the circular economy. So we as a business, we have moved from a linear to a circular model. I think there's a fact, which is we recycle more fibers than we actually use in our products. So we've made this move to circular, and actually through our circular design metrics, we're enabling our customers. So, big customers of ours, Nestle, the Amazons, who come to us with their sustainability questions, how can they become more sustainable as a business? And we're helping them make that transition and that move. So sustainability is at the heart of everything that we do as a business. And as Francis said, you've got to walk the walk, and this really is us living our values, because what we expect of us, we're also helping our customers to achieve as well.
It's a great example of how you bring it to life. Make the short term deliver, but make sure you're prepared for what you need to do next. That's a great example. Thank you. Any questions here in the room that we want to add before we go to another question from our online participants? Great. We've got one in the back there.
Hi, everyone. Renata here from GSK, GlaxoSmithKline. Great panel. Thanks for all your insights. Can you hear me okay? Yeah. I think we touched on so many different key points here around data, credit, partnerships was probably the one that I was missing. So I think that one function in the corporate world that sometimes gets overlooked is the procurement function and the heavy burden it carries and always driving bottom line figures for the business, right? None of this green transition is going to come for free. So my question is, how do you see, it's probably more a question for the panel, but for the two finance experts that we have in there. My question is, how do you see businesses collaborating with each other, possibly in the same sector, where they have mutual supply chains, to drive some of the simplicity that we need on data, to drive some of the scale that we need to really join up forces and achieve Scope 3 results. How does that reflect on the risk profile that we were talking about? Do you see those type of collaborations adding risks or lessening the risks? Because the financial burden of this is not going to go away. So unless we join forces, we're struggling.
Just to start, I think the key is what Alzbeta said about pricing externalities. It's all going to come to make sense, just like the light went on into the central bank governor's head when you talk to them about risk. The light's going to go on in the supply chain when there's a price to it, right? So if by working sustainably, you're actually going to be able to monetize carbon credits at a price which makes sense, then suddenly, your procurement is actually going to factor this into the purchase price of the input. So I think that's the key. And indeed, the data, we all discussed data. Data is super important. And I was just trying to get Lauren to speak about it. And I think the answer is also, it's not just cooperating among competitors in the supply chain, is leading the way as the leader. Right? If you're the biggest and the most respected supplier, and you say, henceforth, this is what I'm going to do, you make it very hard for the others not to follow suit. That's a way to impose partnership, if you would. Okay, but business is not just about nice feelings, but I think pricing is going to play a very, very big role.
Can I jump in there as well? So in terms of an industry approach to decarbonisation, for example, and how we do work with our competitors, our CEO, Miles Roberts, is leading an industry roundtable for paper packaging and recycling. And we've come together and we are not just bringing the problems to the table, but we're bringing potential solutions, but also potential policy levers as well that can be activated. And this is in the context of the UK. But it's, I think it is very much, we are leading this process. And as an intensive energy user, I think we're in top 15 natural gas users in the UK. We're still publicly committing to net zero. And it's a bit kind of, well, we can do this. You don't really have anywhere to hide, actually. So I think you've got to lead by example again.
Yeah. So if I understand your question, the way I would think about this is I go back to radical collaboration again in this area. I think as procurement's going green and going after the supply chain to try and help them share their corporate values, their strategic vision, there will be short-term hiccups along the way because you are educating a supply chain component that really doesn't think about this every day. But through radical collaboration or through partnerships, as you were alluding to, I think there's tremendous value. And it's not new. I mean, if you think about this even in terms of utilities that get formed and the economies of scale benefits, I think over time there's tremendous benefit across the system for what we're all trying to do here. In the US, my easiest example is, for us as banks, we all have to procure customer data. And if we all did that individually as against the benefit now we have of central rating agencies or FICO scores and others, you think about the step up we've had of the amount of friction reduced by each bank going to each customer, or you think of each bank, asking the same kinds of information in different ways through a central utility. That's really the collaboration of saying everybody supplies the same kinds of information. FICO, and I'm using FICO as an example here, standardizes it, but then we, the users, can decide what we want to do with it. So using that FICO score, not every bank gives you the same kind of credit card or the same amount of limit. Now, I'm sure in the early days of that collaboration, it was a very tough process. You thought you're leaving some IP behind, your own assessment profiles behind. But 40, 50 years later, it's been a fantastic outcome. And the same utility structure you can take around pooling of information in so many different areas. So I think the concept is not new. It's really the ambition to get there about, how do you strategically help procurement of different parts come together and build something more centralized that helps the financial system.
That's great, thank you. And I'm really glad, Renata, that you pushed that partnership piece and what it means to really collaborate and do it collectively. So thanks for raising more of those examples through the panel here with that question. That was great. I think we're going to go to another panel. No, we've got an awesome panel. We're going to go to another question from our online audience.
Thanks, Diane. This one is for David, for the rating agency. So how do you assess emerging market corporates' exposure to and management of physical and transition climate risks if these corporates are not disclosing this information themselves?
Yeah, so I think I'll try and take those kind of as two separate issues. On the transition side of things, we do kind of look at emerging market corporates where there might be kind of different regulatory environments in place. So, for example, your carbon pricing might not be an issue in domestic markets, but increasingly we see kind of actors such as European Union, kind of looking at carbon border adjustments, looking at supply chain due diligence regulations that will really kind of put the burden on many of these emerging market corporates to demonstrate that they are aligning with the highest possible standards in that region. On the physical risk side of things, I think it comes down to the issue of diversification. So looking, for example, at a corporate that's serving one particular emerging market and purely serves that market, clearly it's got heightened exposure to physical climate risks versus one that's geographically diversified across countries. I think with climate change and with physical climate risk in particular, there's a recognition that diversification over time will only get you so far. Some of these risks are really systemic. So really, I think, although there will be inevitably laggards and leaders in terms of transition risk, in terms of physical risk, and in terms of new engagement with these topics, over time, I think there is a recognition that many of these corporates will have to engage in these topics. Even if the domestic policy drivers aren't that strong, investors are increasingly engaging on these topics. They're increasingly kind of pushing for information. So I think emerging market corporates are really kind of subjected to a lot of the same pressures that maybe developed markets are. It's just a kind of slightly different pace and trajectory.
Great, thank you so much. I was actually wondering a similar question. How do we get to this assessment through all of the markets that we have to operate in? Because that helps inform how we think about our supply chains and our value chains as well. So thank you for that, really good question. You've got one more? Okay, do we have one more question in the room? No? So since we don't have any final questions, what we're going to do now is move to just closing comments, and then we'll come to our closing speaker as well. But I think it's been an incredibly rich conversation. I'd love to hear the ahas and takeaways from each of our panelists on what you've heard and what you think is the biggest action for us each to take. And maybe, Francis, I'll start with you, and we'll work this direction.
Thank you. I think we've covered a lot of things, but I'd like to start with the comment you made on designing the waste out. That's something that I'll keep, right? Because this is kind of the starting point. It's not so much avoiding the consequences after the fact. It's actually not emitting in the first place, right? So designing the energy out of the process, designing the waste out of the process, I love that very much. I'll take away the importance of data as well, I think, which is a key part. And I also take away, not just from this panel, but from the whole conference and from conversations with clients over the past few months, this notion that there's really a shift. The climate risk is coming to the fore, and that means that now we have so many different incentives now for financial institutions to move from their regulators, their financiers, their staff as well. There's who wants to go and work for a dirty brown company anymore, right? So if you want to hire talent, you've got to do things. So it's coming from all sides, and that actually makes me optimistic that we're moving in the right direction. I'm still a bit doubtful about the pace, and that's a message that I like to keep as well, is we've tried hard, but we need to try harder.
Thank you, Francis. Pace and urgency. That's good. Lauren, please.
I think something which I meant to mention earlier is that the more detail we get, the more data we get around Scope 3 emissions, the more opportunity there is actually to cut those emissions themselves. And I think that's, from a business perspective, that's incredibly important. So yes, it's a lot of intense activity and effort to engage with those suppliers and stakeholders, but there is a benefit for our business as well. And the question from the audience, Renata, around partnerships. Yes, we have partnerships with other organizations. So I've talked about the Ellen MacArthur Foundation, for example. And then I also touched upon briefly that we do have an industry roundtable. And I think what's really important is that industries are able to come together and educate governments and legislators around what are those blockers to, for example, reaching net zero. Because yes, everyone does want to commit to that. I think there is that general, that's the direction of travel we're all going in, and there's a lot of goodwill behind that. But we are still a business and we still need to be able to be viable, and we do still need to answer to our shareholders as well.
Thank you so much, Lauren. David, over to you.
Yeah, so I think from my side, some of the kind of key takeaways, probably the point around opportunities. So we can clearly see from some of the contributions here, there is a clamour for investment in green assets. In many cases, historically we've been better at penalising brown, so thinking about thermal coal. And part of the challenge there is the lack of comparability of data, as the fragmented kind of data landscape that we see out there. So I think with developments such as green taxonomy, with developments such as the International Platform on Sustainable Finance, which is working to try and kind of pull together lots of different kind of green reporting frameworks across the world and establishing common principles, that could be really supportive in helping capital markets kind of flowing towards projects and investments and companies that are recognized as green. And then going to the point around partnerships, again, the point around shipping and green ammonia. Shipping's a really fascinating industry where there's so many different suppliers, so many different components in the value chain, whether it's ports, whether it's companies serving shipping, that really have to kind of be brought in. Similarly, the oil and gas side of things. So really kind of collaboration and partnership would be key, I think.
Great, thank you. Alzbeta.
So for me, it became very clear in this panel, and also all day today being a finance day at the COP, is that it's going to be the financial sector that from today onwards will be able to make a difference. And when it's those central banks that actually decide that it's a real risk as opposed to just something that we should be looking at, that is what is going to drive transition. Because when you are moving billions and trillions in the right direction, that will influence the shape of the value chains and supply chains going forward. So that's a huge insight, and it's from all of you. And the second one is, I think, our collective call for better data. I think we need to get data to make better decisions, and the better and deeper we get into the value chains, evaluating what those data are, and the better we understand that just selling the asset or shifting the asset to another country actually doesn't mean anything for the environment. We need to be quite innovative in terms of making sure that it's not just moving the risk around, but rather mitigating that climate risk.
That's great. Thank you so much. And Piyush, closing thoughts to you.
So very quickly, I think, without repeating anybody, I take away optimism around this setup. I mean, talking about supply chain with this degree of enthusiasm, I'm really optimistic of the degree of engagement everybody has, our viewers, our questioners, our audience. So I take away really optimism, and the last thing I would just say is the amount of leadership from Citi in this area, but all of you. And so thank you very much for bringing us together on this subject.
What a great panel. It's been great to have you all. Huge insights. We really have learned a lot. And what I'd like to do now is thank Citi and invite Daniel. Sorry, I did this before. David, please invite David Walker, Managing Director and Head of our Public Sector Group at Citibank, to come in with closing reflections for us on this panel.
Terrific, Diane. Thank you very much indeed. And of course, I'm not Bridget Fawcett, the co-head of sustainable banking as billed, because of course, couldn't possibly be that she would get caught up in meetings here on COP26. But I, first of all, want to say this is a great Finance Day discussion. Diane, I loved your point about ahas. Lots of ahas, I think, here today. The COP Finance Day, I think, has been one of the most collaborative and interesting experiences. I'm thinking of this as crowdsourcing of ideas, narratives, and ultimately solutions. I want to thank everybody here who joined physically in the audience, but I also want to thank everybody who joined globally on the live stream around the world for this, for their interest, but also for their questions. But most importantly, I want to thank our partners. Diane, thank you for representing us as moderator from the World Business Council for Sustainable Development. But to our corporate friends at DS Smith, our agency friends at Fitch, and of course to the Fertilizer Association, but also to our great long-standing partners at the EBRD, and we've been doing a lot of co-creation with the EBRD, and I think this is going to be pushing it forward. And of course, I can't not say thank you to my Chief Risk Officer, Piyush, as well, for his great insight, and he will be leading the work at Citi. A couple of comments from us just on the Citi strategy then from here, kind of so what. COP for us has been helping us kind of reach alignment on some ideas. But here there's been big debate about the size of and the nature of the financing commitment required. Now we're talking about capital, we're talking about flows, we're talking about totality. But an awful lot of money is going to be directed from an awful lot of sources as part of this low carbon transition for the economies. Now, we're a provider of finance, but we're also a provider of financial services. We must need and we must play a very big role here. And I'm going to borrow a phrase from the panel. I said, I guess we are part of injecting climate DNA into that financial bloodstream. I love that quote. I'm pleased to note that we already have a certified sustainable supply chain finance product and program now up and running. And again, a big thanks to our partners in EBRD with this. I should remind you all, this was put in place in response to client demand. When clients, the more forward-thinking ones, started to say, how do we deal with Scope 3? We put some of our best people on it and our co-creation partners. We'll be working with the EBRD, and of course, as a development finance institution, they have some of the best technical competency and capacity building skills, as well as policy and advisory skills. And we're going to push this down into every little corner of the global financial market, and you do that through these channels of supply chain finance. I would be remiss if I didn't tell you that this forms part of Citi's new sustainability strategy. It was announced by our Chief Executive, Jane Fraser, at the beginning of this year. So number one, we commit to $1 trillion of sustainable finance by 2030, half of which will be dedicated to climate. We've been publishing our TCFD annual reports for the last 3 years. Please look at those online. Ever-increasing amounts of disclosure as we figure it out, and we're going along the path with a lot of our partners here. But we're also using this COP to announce our partnership now, our new partnership with the UNFCCC. There can be no better partner for a private sector financial services organization trying to figure out our way forward in this massive decarbonization of our business model by the world's global leading agency in this. And the final prong is dissemination of good ideas. I'm brandishing one here as an illumination, but the public good research reports, the Citi GPS reports, and we've put them out on the impact on nations, the Stranded Sovereigns report 2 weeks ago. This is a report that we've just done on the global carbon markets. On the first day of COP, we also produced the sustainable home as we think about all the impacts across all of the different sectors. So, Finance Day, that really does sort of reflect that banks and investors have a big role to play. We intend to play a very big role, but we want to work with you to crowdsource all the very, very best ideas. So I'm going to wish all of you a very successful set of COP meetings, but perhaps join me in thanking our moderator and our panel for today's really great event. Thank you and goodbye.